So, welcome guys. Um, Welcome to the new video. In this particular video, I'm going to talk you about IAS 40, which is your investment property. So this video is exclusively for IAS purpose. There will be a very few chances, or there will be a like minimum marks for this standard in your SBR paper, as well as F7 paper. So I'm talking not on the from the exam point of view. It is better if you listen this video once and then solve the 2-3 questions. Will it be okay? So let's get started with this particular video on investment property. So what is investment property? Investment property are the property which is held by the company for its for earning rental and for capital appreciation. Investment property does not company does not hold investment property for the purpose of purpose of its own use, or for the purpose of sale in its ordinary course of business. Okay, second thing you need to remember is this recognition. So what is the recognition for investment property? The initial recognition and measurement are two different things. Recognition: when will you recognize the investment property in your books of accounts? There are two things. One is it is probable that future economic benefits will flow to the entity, will flow to the entity. Now these future economic benefits will flow to the entity from what, from which thing, like what is the economic benefits investment property will give to the company. The two things, whether it is rental income or capital appreciation. So future economic benefits will flow to the entity from the rental income, and second thing, capital appreciation. Okay, this is first point. And second thing is that future economic benefits will which is reliably measured by the company, then only we can recognize the investment property. Okay, this is all about recognition. Now I am talking about measurement. So initial measurement should be at cost. Now cost will include the purchase price, taxes, any other expenses which incurred by the company to make that investment property at include directly attributable expenditure. Like it is directly attributable expenditure. Directly attributable expenditure means putting expenditure which expensed to put that asset into for its intended use. This is your initial measurement. So always keep in mind, initial measurement is at cost only. Now subsequent measurement we have two options. One is fair value option, second is your cost model. Cost model is simply like cost less accumulated depreciation, amortization, impairment loss. That's it. Fair value is calculated on the basis of Ind AS for the purpose of IFRS 113 and your Ind AS 113. Okay, generally talking about exam point of view, fair value is to be given. Otherwise I am uploading a video on fair value measurement. We will see accordingly that. But for the time being, fair value measurement should be on three bases. First is active market, second is observable price, and second is non-observable price, which includes your discounted cash flow and all these things. Okay, now I'm just seeing in my notes, which is I have prepared short notes. Probably I'm scanning it and giving in the description box below, but I'm not confirming it. It just whatever I'm saying, that only written in this note, so that is not issue. So subsequent measurement we have done. We need to subsequent measurement, fair value model and cost model, whatever it is. When there is increase or decrease in the value of an asset, we should record it. And transfer the gain and loss in profit and loss account, not in OCI, profit and loss account. So that is the thing. Disposal. So at the time of disposal, we should record gain and loss. How we should calculate the gain and loss is like net proceeds, that is amount which you have received on the disposal, minus carrying amount which you have in your books of accounts. So the gain and loss will be recorded in profit and loss accounts. Now the most important thing is your transfers. So what do we mean by transfer? Transfer is like from investment property to property plant and equipment, that is Ind AS 40 IAS 40 to Ind AS 16 IAS 16. Okay, so from this to this transfer took place. There are really four types of transfer, but for the for the like what we say, for our benefits or for remembering us, we remember two things. First is from Ind AS 40 to Ind AS 16, Ind AS 40 to Ind AS 2. So that is investment property to property plant and equipment, investment property to inventory. Okay, this statement you should remember, like you should remember. Now I am going to say that always do transfer on carrying amount at the date of transfer which is mentioned. You should keep this in your head. Always do transfer on carrying amount and then apply the depreciation rate or depreciation or the fair value treatment according to the transferred Ind AS. Like suppose you have transferred from Ind AS 40 investment property to property plant and equipment, then transfer took place on value carrying amount of this investment property as on transfer date. From that transfer date, this will be shown in your books of account as a property plant and equipment, and from that date depreciation and all other fair value adjustment should be done according to that particular Ind AS or IAS which is required. That is, suppose in our example, property plant and equipment. So there are 2 to 3 special points which you need to remember. Is that first is property occupied by the employees cannot be classified as investment property, first thing. And then second thing, amount of lease is less than the market rate. Amount of lease is less than the market rate, then it is simply income foregone. It is your opportunity cost. So thank you guys. I hope you like the video. Just do one thing. Investment property is not that much important. Just remember one. Just listen this audio once before going to exam or before starting your preparation. Thank you so much. Good day. God bless you.